Good morning, everybody, and thank you for joining us today. My name is Helen Carvoso, and I'm going to be your moderator. Obviously, things are rapidly changing with the COVID-19 situation at the moment, and today we wanted to provide some insights into the initial government stimulus package and answer some questions you may have about managing employees at this time. We will have two short presentations from Andrew Sykes, the Business Advisory Director at RSM, and John Wilson, who's Managing Legal Director at BAL Lawyers. After this, we will have time for your questions. Can I please ask you to enter these in the Q&A box, which you should see at the bottom of your screen. I'm now going to hand over to Andrew, who's going to talk us through the economic stimulus package.
Good morning, everyone, and welcome. Thank you for taking your time out this morning. The federal government stimulus package is going to provide immediate incentive for business to bring forward expenditure and a measure of cash flow support. It is ideal for businesses who are looking to purchase plant, equipment, and vehicles. It also provides relief for employers through reduced credits against employers' ATO accounts and for those who employ apprentices or trainees. There's four key elements of this we're going to look at in detail today, and we'll also have a look at some other ATO assistance and strategies. Before we get into detail, I will be cautious and advise that all of these incentives are still subject to legislation. And with any type of tax-based incentive, the legislation and final implementation is very important. So remember to consult your advisors, your accountants, before going ahead with anything. Also remember that the asset write-off measures are a reduction in future tax payable, not immediate cash. Therefore, they're ideally suited to businesses who expect to pay tax on profits at any time over the next 1 to 4 years, and businesses who need plant and equipment to improve efficiencies, save labour, and expand. The first measure that we're going to have a look at is the instant asset write-off. To be eligible for this, you must be a business entity. That means you must have an ABN, you must conduct a business and receive business income. Your turnover has to be more than less than 500 million, and previously this cut out at 50 million. So this is a big change from the government. What they've also done is they've raised the limit from $30,000, where small businesses could get an instant asset write-off, to 150,000, excluding GST. This is going to apply to both new and second-hand assets, and those assets must be first used or installed, ready for use, between 12 March 2020 and 30 June 2020. Installed and ready for use doesn't mean when you signed the contract. So if you had previously committed to a purchase of an asset and it's first ready for use and installed after 12 March 2020 and before 30 June, it's going to qualify. So for example, if you purchased a van on the 10th of March for your business and have it delivered on the 30th of March, it's going to qualify for the write-off. Now these changes won't take effect until new laws are passed. And also, the deduction is going to apply on a per asset basis. So multiple assets can be purchased. The example that the ATO uses in their documentation is for 4 conveyor belts of the value of approximately 50,000 purchased for a business for a total claim for 200,000. The whole 200,000 is deductible in this current financial year as an instant asset write-off. So this is going to be beneficial for businesses that expect to pay tax in relation to 2020. The backing business investment is also, if you just move that slide down. You must also be a business entity for the backing business investment. So you have to have an ABN and you have to receive business income. Your turnover also has to be less than 50 million, and you will get an immediate deduction of 50% of the cost of an eligible asset on installation. The existing depreciation rules will apply on the balance of it. So we've had a bit of confusion around this with the view that 150% deduction arises. It's not. So for example, if we purchase an asset worth 200,000, as soon as it's ready and installed for use, we're going to get an immediate deduction of 100,000. The balance of the 100,000 will be depreciable as per normal depreciation rules over the useful life of the asset. Different to the instant asset write-off, these assets must be acquired after 12 March 2020. So if you had committed to the asset prior to 12 March 2020, it's unlikely, subject to seeing the detail, it's unlikely to qualify for this 50% deduction. And also differently, the asset, there is no limit on the cost of the asset, and the asset must be installed and ready for use by 30 June 2021. It will only apply to new assets, and as I said, there is no cost limit on it. So we expect this to be beneficial for businesses expecting to pay tax in the 20 and 21 year. When we have a look at the measures for boosting cash flow, there's going to be temporary cash flow support for employers who employ staff. So you must be an employer business entity with an aggregate turnover of less than 50 million, and eligible employers will receive a refundable credit of up to 25,000 with a minimum of 2,000 for the following activity statement periods: March, April, May, and June 2020. The 25,000 is the maximum credit in total over this period and will be applied as a credit to the employer integrated client account with the ATO. The credit is broadly calculated as 50% of the PAYG withholding tax liability for the relevant activity statement period. There's going to be a difference, and we'll run through some examples. There's going to be a difference between how it's applied for monthly and quarterly payers. For monthly payers, they're going to receive 150% of the March PAYG amount on their first lodgement. For quarterly payers, it will be 50% of the March quarter obligation. So if we run through an example to make that a little clearer. So an employer
Sorry, Andrew, I think we lost you for a moment there.
am I back on?
Yes, we can hear you now.
Okay, sorry. Okay, so I'll start again from this example. So an employer with multiple employees remitting 15,000 per month in PAYG. Now, if they're going to be a monthly payer, the rule is 150% of the March amount. So for that first lodgement, so when you lodge the IAS for the March month, you'll get a credit of 22,500 applied to your ATO running account. When you then lodge the subsequent IAS in respect of the April period, you'll get
Now, Andrew, I think you've dropped off again.
sorry, am I back?
Yes, we've got you back.
Yes. Issues there. Up to the maximum cap of $25,000. There'll be no credit for May because the cap has been reached, and there'll be no credit for June as the cap has been reached. For a quarterly payer, the obligation for the PAYG for the 3 months is 45,000. They'll receive up to a 50% credit of that, or in this case, 22,500. When the June quarterly lodgement is made in July, the balance of 2,500 to reach the cap of 25,000 will be credited to the running account balance. If we look at the next example, a smaller employer who's paying PAYG of $5,000 per month, for the monthly payer, they're going to get 150% of that 5,000 on the lodgement of the March IAS. So for 7,500, there'll be then a further credit in relation to April of 2.5, the same for May and the same for June. It only applies up until the June period. So total credits in this case will be 15,000. The balance of the cap is lost. If we have a look at a quarterly payer in the same situation, it's going to be 15,000 for that quarter. So it'll be a credit of 7,500 or 50%. And in the June quarter, the same 50% or a credit of 7,500 with the balance of the cap lost. So important to note on this is that it's going to be a tax-free, this 25,000 limit. And if it causes a refund, the ATO is committed to paying that refund out within 14 days. We look at the support for apprentices and trainees. This is going to impact on any eligible business who employs staff, has fewer than 20 full-time employees, and has an apprentice or trainee. So importantly, that apprentice or trainee must have been employed as at 1 March 2020. So if you meet those conditions, you'll receive a wage subsidy of 50% of the wages paid during the 9 months starting from 1 January 2020. That will be a maximum reimbursement of 21,000 per eligible apprentice to a limit of 7,000 per quarter. So you'll have to register for that, and registration should be open early April, and it will be a quarterly lodgement with the last and final claim required by 31 December 2020. Also, and importantly, if you engage, so if you don't currently have an apprentice, if you engage an apprentice or out of work trainee, they will qualify for the subsidy. So if you don't have one now, you can actually put an apprentice on. So that's a brief summary of the stimulus packages, and we'll just have a look at some other ATO support that is available. So the ATO is saying for affected industries, they will allow payment deferrals for up to 4 months. So this applies to income tax, BAS, FBT and excise payments that are due. Affected industries at the moment, the ATO is certainly approving cafes, hospitality, gyms, anything that has been immediately affected. So to get that concession, you need to contact the ATO and ask for it. Businesses that are on a quarterly reporting cycle can opt into GST reporting monthly. That's not going to change your PAYG reporting or payment obligations, but what it will allow you to do is get quicker access to GST refunds. Small caveat on that is you have to stick with it with the monthly for 12 months before you can change back to quarterly, and that would apply from 1 April. The ATO is also going to allow quarterly payers to vary PAYG instalments for the March quarter. So if you're making PAYG instalments, you can vary that down to nil. And if you choose to do that, you can then also lower or request a refund for your September and December quarter. So that's for instalments for tax for this year that you've paid through the PAYG instalment system. If you're a monthly payer, the only guidance is the ATO is saying you have to give them a call and ask them. And they're also advising that there will be low interest payment plans, and they'll also consider remitting interest and penalties incurred after 23 January. Once again, they're advising that you need to demonstrate that the business has been impacted by COVID-19 and contact them. So that's a brief summary of the ATO support and also the stimulus packages. I'll hand it back to you, Helen.
Thanks for that, Andrew. I can see we've got a few questions coming through, which Andrew might be able to answer offline whilst I pass over to John, who's going to talk us through some of the questions around employees and flexible working. Thanks, John.
Thank you, Helen. My purpose today is to provide for everyone some of my thoughts and the general principles that apply to the two things I'm going to talk about. Of course, I can't give legal advice to people as individuals. The purpose is really to whet people's interest in if they have any further questions that pertain specifically to them, to take advice. I'm happy to talk to anyone in that regard. But the two main aspects of legal advice that I'm being asked in the light of the COVID-19 crisis really concerns, firstly, going about making arrangements for the performance of work off location or off normal location. And that largely concerns working from home. That issue is particularly pertinent for people that work in offices or other service delivery businesses that people can work at home doing. The other aspect is what if I need to change other working arrangements, conditions and entitlements of employees? What are the legal issues that surround me going about doing that? Firstly, from working at home, the initial question, of course, is can I require an employee to work from home if they otherwise can perform all or some of their normal duties from home? The general principle there is, in this current situation, yes, because it's always the case, regardless of any pandemic, that employers are entitled to give employees lawful and reasonable directions. In very rare cases, the contract of employment will confine the employment to a particular location, but in the vast majority of instances, that's not the case. Now, is a direction to work from home if work can otherwise be performed at home lawful and reasonable? In most situations, the answer to that question is going to be yes. Lawfulness really concerns the notion of illegality. You're not asking employees to do anything illegal in working from home, and given the crisis and the fact that the authorities are discouraging people from being proximate to each other in work and to implement social distancing, it's clearly, in my view, a reasonable direction. So having established that, what are the two issues that you should be giving consideration to in relation to having employees work from home? The first issue concerns work health and safety. In every state and territory, there is a Work Health and Safety Act, which more or less says the same thing. And the first point to make is that Work Health and Safety Acts pertain to employers ensuring the safety of workers at places where work is carried out for a business. And indeed, the definition of workplace in every Work Health and Safety Act is a place where work is carried out for a business and includes any place where a worker works or goes to work or is likely to be while at work. So that would include the home when the worker has been directed or agreed to work from home. And if that is the case, it immediately gives rise to the fact that if a worker is performing work at home at the direction, request, or of the employer or by agreement between them and the employer, the primary duty of care on the part of the employer arises, and that means the employer must ensure, so far as reasonably practicable, the health and safety of the employee while they're working from home. Now, that might initially sound difficult, and the immediate question I'm asked is, well, how do I do that? I can't possibly go around to everyone's home and ensure that it's safe, and I can't reasonably possibly go to everyone's home and get people to, independent people to carry out safety audits and the like. What do I do? I consider that it's relatively easy and straightforward for employers to satisfy themselves that employees' homes are safe for them to work, simply by preparing a checklist of that the employee themselves can complete and return to the employer any issues that appear to arise from the review of the checklist can simply be dealt with. I might make this point that whilst employers have the safety duties that I outlined, similarly, employees have duties of cooperation in assisting that workplaces are safe. And so the employee, if you prepare a checklist and say, well, look, complete this, go around your house and return it to me, they must cooperate. And as a matter of a common sense practice, that's how employers can satisfy themselves that their employees are safe from the perspective of them performing work from home. And your safety checklist will simply carry items like safety equipment, exits, designated work areas, electrical aspects, work surfaces, monitors, desks, keyboards and mouse chairs, practices that employees are going to be doing, and how they're going to notify incidents. I have a checklist generally prepared, so if anyone needs to talk to me about that, they can do so through you, Helen. The other aspect is, well, what if an employee has an accident at home whilst they say they're performing work? Ordinarily, that accident will be covered if it's demonstrated to be in the course of performing work by your workers' compensation policy, but my recommendation is you seek advice from your workers' compensation insurer. The other aspect that is changing arrangements and conditions and entitlements other than working off-site, the question is asked of me, been asked of me constantly, well, what can I do in terms of changing workers' hours if I need to, reducing wages, and other entitlements if in the unhappy event I need to. The basic principle is that you need to first look at the contract of employment, if you have one, or the letter of appointment, to see what it says about those sorts of things, and also consider the modern award or enterprise agreement that relates to your business. All that aside, the easiest way to, of course, to implement changes in work arrangements, conditions, and entitlements, including wages, is to have the employee agree to them. For those employers, who are employing employees under modern awards, of course, they need to be paid the minimum under the modern award. However, there's no reason, even if that's the case, that is, you're covered by a modern award, that you can't get the employee to agree to work lesser hours, and by virtue of that pay less wages because they're working lesser hours. Then the question arises, well, what if I can't get the employee to agree with me? There are really only three possible options. Option one is to suspend their employment. As a matter of common law doctrine, if employment is suspended, there is no need for the employee to perform any work. Conversely, or on the other hand, there is no legal requirement for the employer to pay the employee any wages. Now, suspension is a matter that is can only be activated if there is a term in a contract of employment or in a modern award, which is rare if ever, or in an enterprise agreement, and the extent of the ability and the circumstances of the ability to spend, including to reduce or remove the payment obligation to pay wages during the duration of the suspension, is determined by what the particular instrument says. Now, the next option is to stand the employee down. Now, that's different from suspension, because stand down is a right under the Fair Work Act that applies to every business, and the Fair Work Act says that an employer may stand down an employee during a period in which the employee cannot be usefully be employed because of a stoppage of work for any cause for which the employer cannot reasonably be held responsible. So it is not arguable, in my view, that in most, or at least that where there's a stoppage of work caused by the coronavirus, that it could be said that the employer could be held responsible. So if in your business work in particular areas or units or as a whole needs to stop by reason of the coronavirus, then that stand down provision in the Fair Work Act can be activated. And the consequence of that is that the Fair Work Act goes on to say that the employer's not required to make payments to the employee for that period of the stand down. The final option, if there's no agreement to change work arrangements, conditions, or entitlements, is you might have guessed, terminating the employment. Now, In that circumstance, the question has often been asked to me, well, what do I have to pay? Is it a redundancy? My general view, or generally speaking, if the employee does not accept a change in their hours or wages, it's not going to be a redundancy. Now, that might sound counterintuitive, but I say that for this reason, that the courts have said that the hours that a person works or the wages that they're paid are different from the position they occupy. And so whether an employment is redundant or not depends on whether the employer still wants them to perform the position that they currently occupy. Indeed, the Fair Work Act says an employee is entitled to be paid redundancy pay by the employer if the employee's employment is terminated at the employer's initiative because the employer no longer requires the job done by the employee. Now, in this case, or in most cases, I anticipate that it's not going to be the case that the employee doesn't want the job to be performed anymore. It simply wants to reduce the hours of the job for a time or to reduce the wages. And so it is not, in my judgment, a redundancy situation. So there, Helen, the general points and principles I wanted to make, both in relation to arrangements for performance of work off normal location and the ability or otherwise to change work arrangements, conditions and entitlements. So I'll throw back to you, Helen, to moderate.
Thanks for that, John. I can see that we've got a few questions that have come through, so I might ask the first one to you, John. Yes. If we have an enterprise agreement in place and it states that work needs to be done between 6 a.m. and 6 p.m, can this still be overcome with a simple employee agreement to work hours outside this time, but within their standard 38-hour week?
All I can answer, of course, as I said before, is with general advice. If the enterprise agreement only enables work to be performed by between those hours, then there is an immediate difficulty. However, enterprise agreements like modern awards also contain or must contain flexibility agreement provisions, which one of the provisions that enables employers and employees to agree to is to change hours of work from the general hour provisions at work when work is to occur in the enterprise agreement. So my short point is, yes, it can be overcome through a simple employment agreement that matches or does what the workplace flexibility agreement clause in the enterprise agreement allows to happen.
Thanks, John. Andrew, is the PAYG credit available when employing short-term casual staff on and off during the year?
Thanks, Helen. Yes, we believe that it is. As I said, subject to the final detail, but our understanding is that it is going to be for all employer businesses, and it's based on the PAYG that you pay during that those 4 critical months. So it's going to apply to March, April, May, June. If you pay PAYG during that period, you will be entitled to it. If you don't pay a lot of PAYG, there is a $2,000 minimum, and you will get that on your first lodgement. So if you do a small amount of PAYG, if you had that in March or you have that in April, your first lodgement, you'll get your $2,000 minimum.
Thanks, Andrew. John, what about the costs of working from home? So things like electricity, heating, use of personal equipment, and so on. Are these costs considered to be offset by the lack of costs in physically commuting?
As a general principle, the Fair Work Act prevents employers requiring employees to pay for items that are principally for the employer's benefit. Nonetheless, I think I make 2 points in relation to this. Firstly, that famous old thing, common sense needs to be applied here. And I would have thought that the employer could rightfully say, look, any such costs that you are incurring are offset for the very reason that the questioner asks, and that should in practice be sufficient. And the second point I make is, even if it is a breach of the Fair Work Act for an employer to insist that the employee bear those costs, I doubt very much that the Fair Work Ombudsman, given the current crisis, is going to be inclined to do anything about it. They have far bigger fishes to fry in terms of gross underpayments that are still happening, coronavirus or nothing, than be dealing with, let's face it, minor squabbles about small imposts in the nature of electricity and heating and use of personal equipment.
Thanks, John. We haven't got any new questions, so if anybody else would like to ask a question, please do feel free to enter that in. But in the meantime, I might just share or ask Andrew to share his response to the question, if a client has a payment plan in place with the ATO, will the BAS refunds be offset against that debt? And or can you apply to have the repayments frozen, especially when the business will not have any income for the next 6 months at least?
Thanks, Helen. I think this is a really good question. If you have an existing debt, the only guidance we can give is that the ATO is saying that they will apply a credit to the running account. My view would be that if that credit doesn't exceed what's owing in there, you won't get any actual refund or cash payment. Suggestion in that case is to go back, if you have an existing payment plan, go back to the ATO and ask to set up a new payment plan. Even prior to this crisis, we had been getting good results. We're getting up to 2 years, so 12 months to 2 years as a payment plan. So go back to the ATO, ask for a new payment plan based on the lower balance. You can also look at that 4-month deferral, and if there is a situation where the business has been severely impacted, is not going to have income, you can ask for that deferral of payments that are due.
Thanks for that, Andrew. I think we've, unless there are any other questions that you wanted to comment on there, Andrew?
I think the only other question that's come up in previous webinars was the employee, the apprentice incentive. That's actually payable per apprentice. So it's quite a good incentive. You have multiple apprentices. It's 21,000 or 7,000 per quarter based on 50% of the wages over that 9-month period. And as I said, it's per eligible apprentice or trainee.
Right. Thanks very much for sharing that, and thank you both to Andrew and John for taking us through that today, and to everybody for joining us. We are going to be running additional webinars on related topics, particularly as details change surrounding the coronavirus and possible stimulus packages. You can find details of these on our Coronavirus Resource Centre, and I've just left the web page up there, so it's on the RSM website at rsm.com.au/coronavirus. Thank you for joining us today. We will be making copies of this webinar available up on that resource centre as well, and to our attendees today. So thanks very much for your time.